Today on Alpha Wave Finance, July 13, 2025, something remarkable unfolded. Global markets shifted like tectonic plates, revealing fresh cracks and hidden strengths. Emerging economies roared. Crypto took a surprising turn. Energy prices trembled, and central banks dropped a bombshell policy pivot. Right here and now, you'll gain clarity on what this all means for your investments, your confidence, and your next big move. These aren't distant macro numbers. They are forces shaping your financial future. By the end of this video, you'll be equipped, energized, and ready to ride the wave. In Brazil, the central bank launched a stunning move, a surprise rate cut of 100 basis points overnight, pushing the Bovespa index skywards by nearly 4.5%. That's a kind of abrupt move that can reshape investor sentiment across Latin America. For global equity portfolios, this signals a potential new cycle, not just a flash in the pan. Expect currency inflows, bonds to tighten, and proxy commodity plays to light up. If emerging markets have been on your radar, now may be the precise moment to seize opportunity. Meanwhile, over in China, authorities rolled out a new digital yuan lending pilot targeting 50 million small business owners, ushering digital finance into everyday commerce. This is not a toy experiment, it's infrastructure. That kind of scale means we're witnessing a shift from crypto novelty to regulated digital mainstream. Money flows where trust flows. The ripple effects will amplify global fintech and alter B2B and B2C narratives worldwide. Wise investors are watching this closely. On the other side of the world, Tesla's stock plunged 12% intraday after Elon Musk confirmed a production freeze to optimize its Texas and Germany factories. Execution risk hit big, but that's not the end of the story. Historically, such strategic pauses often pave the way for more efficient future output and bigger margins. For disciplined investors, that dip could be a golden retracement. Know the story beyond the spreadsheet. Bitcoin broke through the 115,000 mark after institutional inflows in Europe hit $1.8 billion in under 24 hours, signaling that big money is no longer dipping toes, it's swimming. Institutional capital brings lower volatility and higher credibility. As Bitcoin climbs, volatility may compress, but liquidity expands. Time to reevaluate your crypto thesis. Are you in line with the smart money? If not, ask yourself why. Ethereum surged 7% today after two major DeFi protocols integrated cross-chain bridges powered by the new Falcon interoperability standard. That means Ethereum is evolving from a single blockchain into a multiverse center. This structural growth supports decentralized finance storming into mainstream capital. For DeFi users and investors, it's more than a rally, it's proof of concept. Growth rooted in infrastructure is harder to deflate. In commodities, nickel soared 15% and cobalt spiked 12% following a sudden mine shutdown in Indonesia due to heavy rains. Metals beyond copper are quietly changing the green energy narrative. Batteries, EVs, electronics, they all depend on this duo. Base metal traders, take heed. Supply squeezes change sentiment fast. A wider rally across metal plays might be beginning. Oil dropped 4% today after Russian officials whispered they may end voluntary production cuts next month. The market responded fast, crude and energy stocks tumbled. Inflation models are watching carefully. That move could ease fuel costs, but also threaten energy earnings. For portfolio balance, it's time to revisit your energy tilt. Flexibility pays off. U.S. 10-year Treasury yields leapt to 4.7% after Fed minutes revealed officials may favor slowing rate cuts, surprising rate-sensitive markets. This rebound in yields reshapes bond, equity, and housing strategies. If you're in duration-heavy assets, reassess. Bonds aren't broken, they're answering a new tune. Adaptation is key. European stock markets rallied on a strong PMI print and signs that inflation inched lower to 2.2% in Germany and France. Eurozone bond yields dropped, currencies steadied, and market sentiment brightened. That's a sign. Global growth may be stabilizing alongside moderated inflation. For equity allocations, focus on cyclical recovery plays. The European chapter is opening. Gold surged to $3,400 per ounce, gaining 2% despite higher yields. Investors are aggressively hedging against macro stress. That's safe haven muscle flexing hard. When gold and yields both rise, we see demand for protection, not panic. If your portfolio lacks a hedge, this may be a wake-up call. Diversify with purpose, not habit. In U.S. equities, growth stocks skyrocketed. The Nasdaq gained 2.7%, led by tech firms reporting better than expected earnings and AI momentum. Meanwhile, small caps lagged as rotation favored high-margin tech. That divergence signals that efficiency and innovation are still winning. If you're overweight cyclical sectors, consider resizing toward tech. Apple beat expectations with an 11% rise in services revenue, including a surge in regional digital subscriptions in India and South Korea. That's a signal. Global consumer tech demand remains robust, even amid macro uncertainty. Scaling digital services builds recurring income models, a core value driver. For long-term tech investors, it's more than profits, it's resilience. In U.S. consumer credit card balances fell for the third straight month, signaling cautious consumer behavior. But discretionary spending remained stable, indicating selective resilience. For retail and hospitality plays, this nuance is key. The consumer hasn't disappeared, they're simply more intentional, aligned with quality businesses. In FX, the Japanese yen surged 5% after Bank of Japan officials hinted at intervening to halt currency weakness. That move resets currency risk for exporters and multinational companies. Portfolio exposures need recalibration, including currency hedges. Global equity isn't just local, it's multi-currency. A $10 billion cybersecurity merger was announced, two major cloud security firms combining forces. That reflects elevated enterprise demand for digital defense. In a world attacked daily, consolidation equals strategic necessity. Tech investors should watch for synergy, cost savings, and platform dominance. Security isn't optional, it's survival. In fintech, mobile payments startup SoulPay announced a $250 million funding round led by established banks, pushing crypto gateway integration into mainstream banking. That kind of structural shift signals crypto's embedding into core finance. If you see payments as the financial bloodstream, crypto is finding its pulse there. Industrial adoption matters deeply. U.S. jobless claims dropped unexpectedly, pointing to labor market resilience. That's a sweet spot for equities, but a potential challenge for rate holders. If unemployment stays low, the Fed may stay cautious on cuts. That shifts risk expectations across asset classes, and your portfolio too. Corporate bond spreads narrowed to multi-month lows as investors chase yield in high-quality names. That risk-on signal suggests confidence in corporate earnings and faith in recession avoidance. But tight spreads also minimize buffers, carefully manage exposure. Balancing yield and safety is now a performance test. Looking ahead, this week brings OPEC meetings, US CPI release, Fed chair testimony, and Brexit-related EU trade discussions. Any twist could tilt markets. You've seen today's moves, but tomorrow writes the next chapter. Act informed, stay fast, and ride Alpha Wave together. Hit like, subscribe, and drop your comment.